Listen up, folks. Picking stocks isn't a game of chance. But here's the kicker. There are thousands of stocks out there. How do you separate the winners from the losers? That's where a systematic approach comes in handy. Think of it like fishing. You don't just cast your line anywhere in the ocean. In the stock market, that means focusing on the right sectors at the right time. You need to combine two powerful methods, top-down and bottom-up analysis. Think of top-down as looking at the big picture. Bottom-up is more focused. Today, we're going to focus on the top-down approach. Instead of looking at thousands of stocks, you'll focus on the sectors with the most potential. It's like knowing which part of the lake has the most fish. Once you've got that figured out, finding the best stocks becomes a whole lot easier. Alright, let's dive into top-down analysis. We're talking about looking at the entire economy to figure out which sectors are primed for growth. What are we looking for? Economic indicators. These are the clues that tell us where the economy is heading. We're talking GDP growth, interest rates, inflation, foreign exchange rates, and government spending. These aren't just boring numbers. They're the pulse of the economy. Each of these indicators tells us something different. GDP growth, that's like the speedometer of the economy. Interest rates, they're the gas pedal. But here's the thing. These indicators don't affect all sectors equally. Once you get this, you're halfway to becoming a stock market pro. Now, let's get specific. How do these economic indicators actually affect different sectors? Let's break it down. When GDP growth is strong, consumer discretionary sectors tend to boom. On the flip side, when interest rates are falling, banks often benefit. Lower rates mean more people borrowing money, which is good news for banks. Lower interest rates can boost the entire economy by making it cheaper for businesses to invest and grow. What about inflation? Well, that's a double-edged sword. Moderate inflation can be good for some sectors, like real estate. But high inflation, that's bad news for just about everyone. Foreign exchange rates are another crucial factor. A weak rupee can be great for export-oriented sectors. But for sectors that rely on imports, like oil and gas, a weak rupee can spell trouble. Section 4. Government policies and sector performance. Let's talk about the elephant in the room. Government policies. These can make or break sectors faster than you can say bull market. Take government spending, for instance. When the government opens up its wallet, certain sectors stand to gain big time. Infrastructure is a prime example. When the government announces big infrastructure projects, companies in construction, cement, and steel often see their stocks soar. But it's not just about spending. Government borrowing plays a huge role too. When the government borrows heavily, it can crowd out private sector borrowing. This can lead to higher interest rates, which can be tough on sectors that rely on cheap credit. Section 5. The inflation factor. How rising prices affect stocks. Now, let's talk about everyone's favorite boogeyman, inflation. When prices start rising, it affects different sectors in different ways. Take the commodity sector, for instance. When inflation is on the rise, commodity prices often follow suit. This can be great news for companies in sectors like metals, mining, and energy. But for other sectors, inflation can be a real pain in the portfolio. Consumer staples, for example, can struggle. As prices rise, consumers may cut back on spending or switch to cheaper alternatives. Section 6. Narrowing down. From sectors to individual stocks. All right, folks, we're in the home stretch now. You've got the big picture. You understand how economic factors affect different sectors. Now what? It's time to zoom in and find the best stocks within those promising sectors. This is where bottom-up analysis comes into play. But here's the key. Don't jump straight to individual stocks. Start by narrowing down your sectors. Use the top-down approach we've discussed to identify the sectors with the most potential. Once you've got your sectors, then you can start looking at individual companies. By starting with sector analysis, you've already given yourself a huge head start. Now get out there and start fishing for those winning stocks.